Only the fit survive in today's competitive world. Recent figures have shown that an average of 44 small businesses close their doors every week in Australia. This E-Class series provides vital information for small business owners and franchisees when they're starting out on their small business journey. Today we're looking at debt, why use it, and how to manage it. Debt is a fantastic help, but it can be a real problem too. The reality is many business owners end up with debt managing them rather than the other way around. Today we're going to look into what debt is, what debt does for a business, how much debt is enough, and sourcing debt. Let's start by looking at what debt means to a business owner. Debt is used to multiply the efforts of your own equity. Owner's equity is the money you put into the business. If we add debt to equity, we have the business's assets. More assets allow the business owner to build a larger business operation and hopefully make more money. The logic is that if your business is generating a return on assets of, say, 20%, it makes sense to borrow cash at 7%, giving you a net 20 minus 7 equals 13% return on the debt. This clearly makes sense. The problem is that as you take on more debt, there's a greater risk to the business because in addition to the operating costs, there's also an interest cost associated with the debt. In business, things can suddenly go badly. For example, what if there's a downturn in the economy and sales decrease? What if you lose a key client? What if there's a crippling legal case, an increase in interest rates? All of a sudden, you're not only paying the bills, but the interest cost is crippling you. Can you repay the loan to reduce your costs? Obviously, the bigger the debt, the larger the impact in a downturn. Let's start with a few technical concepts, just so that we can talk about all this a little more simply. The key factor is the debt-to-equity ratio. What proportion of the business assets are funded from debt? For example, if you had equity of $100,000 and you borrowed $100,000, then you would have a 50% debt-to-equity ratio. This is also called the gearing or risk ratio. The next concept is the maximum debt-to-equity ratio. This reflects an individual business, the economic conditions, the industry and regional conditions, and particularly the owner's attitude to risk. Most businesses carry some debt. Typically, it ranges between none and 60%. Some businesses operate at much higher levels though, sometimes over 200%. The next key concept is headroom. This is the scope for a business to take on more debt if an opportunity or a need arises without breaching the maximum debt-to-equity level. Another way to think about it is the difference between the current debt-to-equity ratio and the maximum debt-to-equity ratio. So, the benefits of debt are clear, but when does more debt become too much debt? The short answer is when the risk becomes too high. The answer lies in understanding risk and being able to manage the risk that goes with debt. Risk propensity is the term for a person's personal feelings about risk. Some people want no risk at all. Others are very comfortable with risk, so long as they believe it will give them a high return. This is driven by personality, stage of life, personal wealth, family obligations, and a host of other factors. This cannot be measured. It's driven largely by perceptions, and so is different for every single person. Risk management is the practice of assessing, understanding, and managing risk. A common framework is to ask how likely is it that the risk will occur? What will be the impact if it does occur? And so what's the potential risk? Next, what management steps can be taken to ensure against the risk, to manage the risk, or to avoid the risk? In light of these steps, what is the residual risk? And is it acceptable? Use this approach to determine the maximum acceptable debt. Contingency planning is a useful tool to plan actions to take if risks become reality. Having a strong contingency plan gives you confidence to face risks. If something happens, we know how to handle it, and we're confident that we can manage. How does risk propensity, risk management, and contingency planning apply to debt? Well, it allows you, as the business owner, to assess just how much debt you're comfortable carrying. Remember that this comfortable debt level will change over time. When tough times are ahead, business owners reduce debt. While this might lower total profits, it also means that the business is more sustainable and more competitive, operating from a lower cost base. This reflects a reduced owner's risk propensity. When opportunities occur, such as an acquisition chance or a new business line, business owners often increase debt. Debt allows them to capture the opportunity that otherwise they might not have been able to. The owner has to make a decision on the risk associated with debt versus their assessment of the new business structure and outlook. Debt is money belonging to an external party but used in your business. In exchange for using their money, the business pays interest on the debt. Eventually, the money has to be repaid too. So, where and how do you source debt? Small business owners typically use a few common sources of debt: family, friends, banks, other financial institutions. Each has pros and cons and different requirements, but to borrow money, you need to be able to demonstrate that your business is sound, your cash flow can support interest and principal payments, and the lender's money will come back to them in due course. It sometimes helps to think that the lender is investing in you, the business owner, and in your business as a temporary custodian of their money. Franchisees are often able to access more debt more easily and at a lower cost. Why? Because the franchisor has established a proven business model. This reduces the risk for the lender. Independents have to prove not only themselves but also their business model. Lenders usually see them as having larger risk. Independent business owners have to fight to get the money and may often be charged higher fees and interest. A recent APCFE study has shown that, contrary to expectations, access to more finance is often associated with business failure, possibly due to these businesses being overcommitted or lacking good business discipline. So, what have we learnt about debt? Debt is an important part of business growth. Use it, understand it, and manage it. Measure it using the debt-to-equity ratio, also called the risk ratio. Make sure that this ratio is updated at least every month. Remember that risk goes hand in hand with debt. Always aim to have enough headroom in your business to survive a sudden downturn or to snap up an opportunity. Lastly, measure and manage your debt actively. Always know where you sit on your personal debt risk curve. And happy borrowing! For more detailed information on running a franchise or small business, go to www.franchise.edu.au and subscribe to the Franchise Business Management Essentials online program. This program covers the business skills you'll need to run a successful business and is ideal for people with no or limited previous business experience.